What the just happened? I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, Germany's collapse is spreading everywhere, and it's not just spreading to the Eurozone or even as far as Asia, it's spreading to right here at home, which is why we're warning, and you're about to see that the global economy is on the brink of an all-out crisis. Now let's over to Bloomberg, where he picked today's story up with a headline: as German industrial production declines on car manufacturing. And this is a big deal and only part of the story, because when an economy, particularly as Germany's, which is the industrial powerhouse of the Eurozone, loses its manufacturing sector, well, it means we're headed into a recession. But it's not just Germany, it's happening all over the world. As output decreased 2.4% from June, which is worse than predicted by a single analyst in a recent Bloomberg survey. Automotive was the main driver, but here's the key point. Most sectors were down, meaning it's widespread. It's not just limited to the automotive sector. What we're seeing is demand for finished goods from all over the world are plunging, and this is going to send every major industrial economy into a recession. As Germany's economy contracted by 0.1% in the second quarter, dashing hopes that it can finally leave behind years of stagnation. And that's, of course, what we note as rising inflation and rising unemployment, which doesn't last. It's only transitory before an economy plunges into a recession, as a lack of demand leads to price cutting and further unemployment. The fact that Volkswagen is considering an unprecedented factory closure in its home market adds to the gloom, and as you're going to see, that's starting to happen in other countries. On Thursday, the IFO Institute lowered its forecast for this year and next significantly. It now expects zero growth, which is going to be optimistic for 2024, instead of 0.4% before and only 0.9% in 2025, compared to 1.5%. I think we'll be lucky to even see a positive growth rate next year. What do you think? Weigh in the comments. Is a global economy going to hit that soft landing, or are we going to head into recession? Love to know what you think, because let's talk about what's happening here at home. We see that, of course, factory closures coming potentially in Germany. How about here in the U.S.? Is Big Lots just announced that it's preparing bankruptcy finally, with plans to sell stores. So while we're seeing Volkswagen potentially close a factory here in the U.S., we're going to start seeing retailers close stores because of a lack of demand. And this is critical because it's going to put more Americans on the unemployment line. As Big Lots, which has around 1,400 stores and employs over 30,000 people, has suffered from declining sales for years, but that's not the real problem, including the recent quarters, as rising inflation squeezed the wallets of its budget-conscious shoppers, meaning those who typically shop at Big Lots are not seeing enough hours, enough pay increase to even afford the discount retailers' goods. This is a huge problem. They're going to close stores, which means people are going to hit the unemployment line. Their spending power is going to go down, and that's going to reverberate through the U.S. economy. But again, it's happening in the Eurozone. It's happening in Asia. It's happening here. In fact, what's going on in Germany is only going to get worse, as VW weighs the first ever Germany plant closure to cut costs. And this is going to be the beginning of what we're going to see globally of factories closing, because it's questioning the production of its compact electric SUV model at the main car making site in Wolfsburg from 2026. But this isn't about electric vehicles. It has nothing really to do with that. What happened during the pandemic is, of course, we shut down the global economy. But to keep everybody solvent, governments borrowed massive amounts of money and flooded the wallets of all its consumers, which led to an unprecedented surge in demand. And this, of course, created massive backlogs in factories as all of this money got flushed through. The problem is, when you come off this spending high, what happens is demand comes plummeting down, and a lot of jobs are going to go with it. And what's happening in Germany now, just the beginning. As Volkswagen last year made roughly 9 million vehicles, compared with a total capacity of 14 million. And this is exactly the problem with the global economy, because during the pandemic, we shut down the global economy, but we didn't stop there. We see governments around the world borrow massive amounts of money, flooded the pocketbooks of consumers. It created an unprecedented surge in demand, led to massive backlogs at factories, put lots of people back to work as we came out of the pandemic. And now the problem is, without all that stimulus, without all that money flowing through the economy, demand's coming down in a major way. And this is going to lead to not just factory closures, but it's going to lead to business closures all over the world and send millions onto the unemployment line. But if you're questioning your ability to make money in this economy, in this market, well, you shouldn't. Let me show you why. Because we just closed out. Talk about the Eurozone. We just closed out a trade for both of our reports. Here you see EZU up 4.42%. We closed that out just recently. Same with Momentum Timer Pro. Came in a little bit later, up 1.81%. Mine just was a 3-week trade. Now we're going into the weekend here with 4 open trades on our CTA Timer Pro, 1 on our Momentum Timer Pro, but we have the edge. You want to make money. You want to know where to put your money during the change in the cycles. We got you in a big way because we fully backtested CTA Timer Pro. We know the best signals. We know where to go, and soon we're going to have the same data on Momentum Timer Pro. You want to beat the machines when they're in deep short positions and price rallies against them. We know it. We look at the historical probabilities. We tell you what trades to take. You like trading momentum? We do that too, but we look at different time scales. So when we see a shift in momentum, it's a much better trade. Soon we're going to have that back tested as well. Here's what you get: the daily reports, the tradable signals. I give you my opinion. I go through every new trade. I give you the stop loss levels. I track every trade and the returns for you. We give you a weekly update on the stop loss levels. But in addition to the fact you get a 30-day free trial, my buddies don't do it because you can't make money with our system. You can duplicate 100% of our trades. Links in the description below. Don't get hammered when we hit the next bear market. We'll show you how to make money because the plans risk worsening the economic malaise in Germany, where industrial companies are reining in investments. Now, this is a problem because think of this. If you're Volkswagen and you're not even hitting close to capacity, well, you don't really need to invest in upgrading your factories because you already have plenty of capacity. And so as we see manufacturers not investing, well, that means, of course, more jobs are going to get lost, and you're going to see it spread very rapidly. It's already beginning to the rest of the global economy. And here you can see VW's market valuation is sunk to around $51 billion, even as the company continues to rake in profits. Again, we see that in the earnings reports. Companies are still making money, but they're getting cautious. They're cutting back on spending plans. They're cutting back on the hours their people are working. They're cutting back on pay raises. And soon, like we see with Big Lots, they're going to be closing stores and maybe even closing factories. And those jobs, once they're gone, aren't coming back. And today's data is a cold shower for everyone hoping for a speedy recovery. In fact, it suggested the bottoming out of industry still has a long ways to go, as we've suggested. This means we're in the early stages of what is going to be a global crisis, a global recession. This is dangerous because the political elite said there's no way this was going to happen. Not on their watch. They weren't going to allow it, yet here it is, just as we predicted. We already got weak sentiment indicators and the risk of yet another quarter stagnation. Again, rising unemployment and rising prices, or even contraction, is clearly increased. And this is exactly what happens every time before an economy goes into recession. You've seen the data on the U.S. economy. You get rising prices, falling demand, and rising unemployment. Next thing you know, you're squarely in a recession. But look at the sentiment data. They mentioned this for Germany, but how about this here in the U.S. as we turn back to the recent ISM manufacturing data? Look at this, the sentiment indicators. Contraction in manufacturing, contraction in new orders, production, employment, and backlog of orders, and even new export orders. So we talk about how VW might close factories, but what's going to happen here in the U.S.? Are we likely to see factories close? The answer is yes, we are, because there's a problem. While all of that is happening, we're having stagnation here. We see prices continuing to increase, demand going down. That means hours worked getting cut, pay raises are going to get smaller, and perhaps jobs are going to go away, and we're going to see outright plant closures. And this is dangerous because when you start to lose your manufacturing sector, the services sector eventually follows with a lag, and it means there is a foregone conclusion now that the U.S. economy is going to follow Germany's and the rest of the world right into a recession. And Germany wasn't the only country to suffer at the start of the third quarter, as French industrial production numbers published Friday also showed a contraction of 0.5%, worse than what was expected. A sharp reduction in production in the automotive sector was key there too. But again, it's not just limited to Germany. Look at here in the U.S., industrial production, the last data, down minus 0.2% year over year. Again, validating that we're seeing production at the factory level and at manufacturers continue to decline. It's going to lead to many people on the unemployment line and a collapse of the global economy. And recovering the manufacturing sector is also key to reviving Germany's economy. And it's not just Germany, any economy. It could be France, could be China, could be the United States. You need to turn the manufacturing sector around. But how do you do that? You've got to get consumers to go out and spend money on products they want. The problem is they don't have the money because inflation's running too hot and we're seeing demand go down. We're seeing the perfect recipe for an all-out crisis. And this is adding concerns that these troubles are more structural than temporary, which is why we're going to see central bankers, particularly the Fed, start to cut rates here in September. We've seen other central bankers do it. The problem is everybody believes it's going to have some magical powers. We see in the survey results, we see businesses saying, gosh, we just need some rate cuts. The problem is it's not going to make a difference, and even a little bit of boost in the economy isn't going to help. Because German factory orders unexpectedly increased for the second month, not just in Germany. This happened in the U.S., but I'll tell you why it doesn't matter, because the increase was due to large-scale orders, without which the gauge would have dropped 0.4%. The industrial sector of Europe's biggest economy has been stuck in a rut, with business surveys by S&P Global confirming this week that a downturn started mid-2022, extended into August. So what we see starting middle of 2022, we begin the slow phase of entering a manufacturing recession. Many people ask, why hasn't it happened yet? Because the bigger the economy gets, the bigger the world economy gets, the slower it happens. But then all of a sudden it happens all at once. That even in the U.S., when we looked at manufacturers' new orders of durable goods, we had the Boeing effect last month, a big month-on-month increase of 9.8%. Strip that out, it's likely negative as well. And what this means is subdued foreign demand is also a key source for its weakness, but there are also concerns about a loss of competitiveness to China, who is also trying to turn its manufacturing sector around. The difference is the government's saying, look, we're going to force you to produce things and we're going to try to dump them on the open market. Again, what we're seeing is production exceed demand from all over the world. There's going to be a lot of losers, but the global economy is going to be the biggest of them all. As manufacturers are increasingly challenging German firms that have faced elevated energy costs, high interest rates, and staff shortages at home, this is going to lead to further automation as manufacturers look to cut staff to be competitive. This is going to be a problem. More people structurally unemployed, perhaps even higher tech factories will be built. We won't need all the factory power we have now. This is a huge, massive shift. Because Germany's output has been propped up by services, as is the rest of the global economy, and that's not going to last, because forecasts are being revised lower after a surprise contraction in the second quarter. The Kiel Institute for the World Economy said this week expects gross GDP to shrink 0.1% this year after a 0.3% drop in 2023. Things are only going to get worse. There's nothing that's going to change the tide of this, because even we look at wage growth, this is something that a lot of political elites are hinging the change in the global economy on. I tell you why it's not going to work at all, because a key ECB measure of wage growth slows before likely rate cut. But the issue here is at the factory level, they don't understand what's going on, is that backlogs have been worked through. But now at the wage growth level, a lot of people are saying, well, wages are outperforming, of course, inflation. The problem is the wages for those who don't have a job or underemployed, they're not outperforming anything. They're the ones that are falling behind due to inflation. And compensation per employee rose by 4.3% in the second quarter, down from 4.8% in the first 3 months of the year, showing a deceleration in wage growth. In June, the ECB had predicted pay growth of 5.1%, so we're seeing a continued slowing of this that's going to continue to get worse. And there's a simple reason why. You put people on the unemployment line, and yes, you still need to give your key workers raises, but you don't have to give them as big of raises, because they already know They could be next. And here we can see the evidence of that as the unemployment rate, looking at U.S. data in blue against average hourly earnings of production and non-supervisory employees in red. You see a near mirror relationship of this as more people hit the unemployment line. Yes, employers still give out raises even in recessions, but they're not as big because they don't need to do it. That tells us we're going to see a continued decline in average hourly earnings. And for while those are working, maybe keeping up with inflation, it doesn't factor debt service costs. It doesn't factor the recent increase in insurance costs or other mitigating things that don't show up in the CPI. What it means is everybody's falling apart and fast. And officials have been keeping a close eye on corporate profits and workers' productivity to get a full sense of price pressures in the Eurozone. We're going to look at the U.S. data here in a moment because it's very eye-opening. The latter kept declining in the second quarter, an issue that policymakers have increasingly highlighted as a concern. And that's right, because we see when productivity goes down, it's a huge actual issue. What we really want to see is productivity going up. That's really what we're looking at, because that means we're going to see more people hit the unemployment line and we're going to see inflation come down, because what's going to happen is employers are going to rely on the people of haves who are highly productive. They're going to say, you know what, we don't need to add anyone else because we have the people we need right here. Yes, we'll pay them more, but we're not going to increase our payrolls. And look at this. If we talk about unit labor costs first, what we see in blue on a year-over-year rate of change against the consumer price index in red, also on a year-over-year rate of change, is you see unit labor costs are back near the zero bound, suggesting inflation is coming down. And why is that? Because more people are heading to the unemployment line. They're getting pink slips. They're getting severance packages. We're going to see an increase of this because employers are not seeing the demand. They don't have to give out the raises. And that means those that do have jobs are highly more productive. We can see that evidence here as labor productivity in terms of output per hour. You get rid of people, those you keep, they're going to be more productive. That has an inverse relationship with inflation. As productivity goes up, consumer price index goes down. Everything is pointing and everything is telling us that we are on the brink of a global crisis, one that's going to put us in a globally synchronized recession. And that will be the best case, because the worst case is we're going to be in a globally synchronized financial crisis. And when that happens, 0% interest rates aren't going to fix anything. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.